Hello, my name's Robert Gowdy. I'm a financial planner from Meriton Financial Group, and during this video session I'm going to discuss self-managed superannuation funds and the control they bring. Now, the self-managed super fund industry continues to grow in popularity, and it's growing faster than any other superannuation sector. So, what's the big attraction that encourages so many people to go their own way despite all the obligations and responsibilities of being a trustee, and not to mention being regulated by the tax office? And the answer itself is not simple, because self-managing your own super appeals to many different ways to different investors. However, there are a couple of specific attractions. Now, superannuation funds in the accumulation stage are taxed at a maximum of 15% on assessable income, and are effectively taxed at a maximum of 10% on their capital gains, which is not unique to self-managed super funds themselves. But in a self-managed superannuation fund, you as the trustee can decide when to buy and sell the assets, and therefore have control over the potential tax liability, particularly capital gains. Account-based pensions have become very popular because the investment returns from the assets backing the pension are tax-free within the fund, and the pension income paid out to the members is concessionally taxed as well. In a self-managed superannuation fund, you can switch from accumulation stage to the retirement income stage relatively easily. There's no need to liquidate assets to make the change, unlike the arrangement required in many public offer funds. If you sell assets in the pension stage, any capital gains are tax-free. Consider the following example, where Frank and Rosemary have an investment property in their self-managed superannuation fund. It was purchased for $200,000 and is now valued at $350,000. If they sold in the accumulation stage, the capital gain would be taxable and have a potential liability of $15,000, which represents the 10% on the gain of $150,000. If they retain the asset until they're in pension stage, there will be no tax liability whatsoever. Following law changes from July 2007, income from superannuation funds has become a lot more appealing. For those aged over 60, regular income payments or lump sum withdrawals from the fund are completely tax-free. For those aged between 55 and 60, pension payments are taxed at normal income tax rates. However, they come with a 15% tax rebate, which is generally available. And it may also include a deductible amount where no tax payable at all. Some public offer funds and employer superannuation funds are becoming more flexible, but self-managed superannuation funds provide the ultimate flexibility and control, ensuring the rewards come to you. But with anything that's as complex as this, you need to get professional advice before making any final decisions. Thanks very much for taking the time to listen. Please remember that this information is general advice only, and we encourage you to read our disclaimer at the end of the video. Thanks very much.